Welcome to Withum's annual Business and Finance Symposium. In the International Tax section today, we'll talk about the wide world of business. We'll start off with an international tax update by Chaya, Siegfried, and Calvin Young. They'll be talking about some of the OECD changes, base erosion and profit shifting, taxation of the digital economy, and the new 15% worldwide minimum tax rate. We'll then move into transfer pricing updates by Andrew DeSimone, and then we'll lead into international accounting standards updates by Christina, Flynn, and Shannon Metz. I'll close out the section with going about doing business internationally utilizing our HLB affiliations. And now, Chaya and Calvin.
It's an interesting time jumping right in the world of international tax because we don't often make it into the headlines. But if you look at these couple of snippets from mainstream media over the last 2 weeks or so, you'll see that global minimum tax, global deal to end tax havens. This is a very hot topic trending in the news. So why are we suddenly in the news? What are they talking about with this global minimum tax? That's what Calvin and I are going to spend a couple of minutes bringing you up to speed on. So this all started with the OECD BEPS project. So it's a lot of ABCs I threw out there. So the OECD is the Organization for Economic Cooperation and Development. It's a global think tank. It's comprised of about 140 countries. Representatives from those countries get together and talk about different economic initiatives, global initiatives, and of course, tax is a big one amongst those. And so the project, the BEPS, that stands for Base Erosion and Profit Shifting, BEPS, about almost a decade ago, back in 2012 or 2013, the OECD undertook a study to see what were the biggest challenges in global tax, what were the challenges that countries are facing. And in particular, they were concerned with tax planning strategies that large multinationals used to take advantage of gaps and mismatches amongst the world in the tax structure of countries throughout the world, where basically they were shifting profits in a way to get a better tax result, also known to some people as a race to the bottom, a race to the lowest tax rate. And the concern here was the potential for double non-taxation. So we know we don't like when taxpayers are subject to double tax, which is their income being taxed twice, but we also don't want to see double non-taxation, where you have taxpayers that somehow manage to skip around the globe in an effort to avoid paying tax. And so the OECD undertook this project of analyzing the profit shifting and the tax strategies that large multinationals employed to come up with an action plan on how to address these in a collaborative effort. And so coming out of this base erosion profit shifting project, the BEPS project, there were 15 action steps that they identified as necessary to combat the base erosion and profit shifting. Notably, action number one were the challenges of taxing a digital economy. And they felt that this was a challenge that needed to be addressed. And everything that you're hearing in the news recently is a derivative of this action one. It's the result or the action, the actual follow-up that OECD undertook to deal with the taxation of a digital economy. Just as a side, I'll mention some of the other notable actions. There were the hybrid mismatch rules, control foreign corporation rules, the use of interest expense to strip income out of a country, tax treaty abuse, transfer pricing, which Andrew, who is with us today, will also be discussing, and then country-by-country reporting. So these are also, if you are at all tuned into international tax, these are all phrases that you may have heard being bantered around over the last 5-10 years. So in terms of the taxation of the digital economy, we have to look at the two fundamental questions of how you tax a company that has cross-border activities. So the first question is, who has the right to tax? If you have a multinational that's operating in 20 jurisdictions, which of those jurisdictions have the right to tax that multinational? And how much profit should be allocated to each of those 20 jurisdictions? And these are the fundamental questions that we need to address. Why this needs to be discussed from a global consensus, like why can't the US go off and come up with their own solution to these two questions, and then Germany go off and have their own solution? The key is to avoid double taxation, right? We don't want two systems, one in the US and one in Germany, for instance, that may conflict each other. And then you have a result where you have a multinational that operates in the US and in Germany, and they're paying tax on the same income twice. So we don't want that. That's not good tax policy. None of the tax authorities want it. The OECD doesn't want it. So that's why we need to work in a consensus and a collaborative effort to address these questions. The other major concern is we need to create a mechanism for resolving controversies. And we see this a lot in the area of transfer pricing, where countries may have conflicting ideas about how transfer pricing should be applied. And there needs to be a mechanism for the tax authorities to resolve that. It is worthwhile to note that many countries have gone ahead and already passed their unilateral, what they call digital services taxes. And that's something that we really want to avoid, because that's not good tax policy. And at the end of the day, the multinationals suffer from that. So you might be wondering, well, what's the difference if we're dealing with a digital economy or a non-digital economy? What difference does it make in answering those two questions that we had up there just a few moments ago in terms of who has the right to tax and how do you allocate substance? How do you allocate income? And the answer really is that the traditional principles of international tax revolve around physical substance. So the way that most developed countries address those two questions very much revolve around physical substance. If you have physical substance in a country, we can tax you. And depending on how much physical substance, that's how much we're going to allocate to the country, right? So physical presence, permanent establishment, these are all the concepts that we've been dealing with historically to date, in terms of how you address those questions and how you get taxed. And allocation of income also, it's based on where you have functions and assets and risks. So again, physical. But, incomes, I'd like to use Netflix as an example because it's so easy to demonstrate. So incomes are Netflix, and I don't know exactly where they have employees, but let's just say arguably they could have all of their employees based in the US and still manage to stream $20 million worth of content into Germany. And so based on the historical, or I don't want to say the historical, but the traditional taxation principles, if they're just streaming content into Germany and they don't have any physical presence in Germany, Germany does not have the right to tax them because they don't have a permanent establishment there, they don't have physical presence. And so, if you look at that picture, if Netflix is deriving $20 million of income out of Germany, Germany should have some ability to tax that activity. And so that's the crux of why we need to address the taxation of a digital economy differently than the traditional principles of international tax. If for those of you that have dealt with the US state and local tax issues, you may be thinking to yourself, this is a common theme to what we've been seeing in like state and local sales tax. And now we're seeing this in state and local income tax, where we're looking at like a digital nexus. It is exactly correct. It's the same conversation, the same transition, the same ideas that we're looking at, but from a global level. I would say the state people are lucky, or they get off easy in the sense that like each state goes out and makes their own rules and doesn't consider every other state. Here with the OECD involved, we're looking for this consensus. So that's really what you're hearing in the news, is this consensus and agreement on how we should go about changing things so that we can tax the companies like Netflix or other similar structures where there's just customers in a country, but not necessarily physical presence. So, the agreement that we're seeing out of the OECD, and Calvin will go into it in detail, just to give you a breakdown, not too much detail, but enough to give you an understanding of what we're looking at. We have pillar 1, pillar 2, pillar 3 is kind of off the table, but these are the catchphrases you may be hearing about pillar 1 and pillar 2. And so, Calvin, can you give us a little bit more understanding of what each of these are and what the approaches that they're looking to take?
Yeah, definitely. So if we could go to the next slide. So as recently as 2 weeks ago, the OECD just announced that they have about 136 countries, member countries of the OECD, that have agreed to these the pillar 1 and pillar 2 proposals for a global minimum tax rate. This global minimum tax rate under the OECD materials, they've agreed to 15%, and all these rules are built around preventing large corporations from shifting profits to low tax jurisdictions, and also place limitations on tax competition between governments. As Chaya mentioned before, that there's sort of a race to the bottom where governments are implementing their own rules to either incentivize businesses to do business there, or other benefits that these corporations will take advantage of and structure their affairs to take advantage of the low tax rates. So of all those 136 countries, that represents about 90% of global GDP. And there's currently 4 OECD members that have not yet signed on to the OECD proposals. That includes Kenya, Nigeria, Pakistan, and Sri Lanka. But as far as for these rules to work, they would need essentially everyone to agree to this for it to work. Because otherwise, if everyone agrees to it and one country doesn't, they can go off and make their own rules and incentivize companies to do business there, where it would undermine the whole system. And also the OECD did put a time frame on implementing these rules, and the planned implementation date for all the changes to be live is by 2023. And that's there are some challenges to that. It's only 2 years away.
It's ambitious.
Yeah. And with considering everything that has to be done within each country's government for that implementation and changes of these rules to go into effect, at least here in the US, they would need Congress to pass, amend the laws here and effectuate these changes. And then also the treaties would have to be redone to have correct language to implement these rules. So 2023 does sound lofty, but we will have to see how everything goes in the next couple of years to see if that target date is realistic. So going into some of the details of these changes, there's pillar 1, which essentially reallocates taxation rights within countries based on where the sales are located rather than where the company is located. So some thresholds for these rules to apply. It applies on companies with more than $20 billion in revenues, and which have a greater profit margin greater than 10%. And if they do fall under these thresholds, then they'll be taxed on 25% of their profits will be the taxing rights on that 25% will be reallocated to the countries where the actual sales take place rather than the country that the company is located in. And it's also notable that oil, gas, and mining companies are exempt from the Pillar 1 rules, and also the unilateral digital services taxes that Chaya mentioned before, within Pillar 1, there is a provision for any country that has implemented unilateral measures, such as those digital services taxes, to remove those taxes. And now Pillar 2, that is more rules around the global minimum tax. As I mentioned before, they decided on a 15% minimum effective tax rate on the taxpayer, and that's going to function like a top-up tax on the parent company to achieve that 15% effective tax rate. And this minimum tax would be applicable to large multinational corporations with over 750 million euros in global sales. A example of this global minimum tax and how it would work. So here we have the structure on the slide here. It is a U.S. parent company with 2 subsidiaries, one in Ireland and one in the UK. So if we assume there's $100 of income in each entity, the U.S. parent company would be paying $21 in tax. The UK company would be paying $19, and the Irish subsidiary would be paying $12.50. However, with the Pillar 2 rules applied here, because the Irish entity is paying only 12.5%, a 12.5% tax rate, to the parent company will be subject to an additional $2.50 of additional tax to essentially bring that that Irish tax rate up to 15%.
So eliminates the benefit of putting your income in a lower tax jurisdiction. So even though the thresholds here are pretty high with 20 billion, firstly, there's definitely expectation that those thresholds go down. And also some of the ideas built into these new rules filter out to treaties, like Calvin said, the thin capitalization rules, that, and of course, transfer pricing. So, if you're a smaller multinational and you're wondering how this impacts you, these are kind of the 4 areas that you should consider. Even though the rules don't specifically apply to you, it would be a good idea to take a look at these issues and see how those might impact you.
For our next topic, Andrew DeSimone will walk us through transfer pricing, what it is, why it matters, and how it's changing. Transfer pricing is all over the news, whether related to case law or new guidance. Transfer pricing is being talked about. Over the next few slides, Andrew will address questions that you, operating globally, will want to ask yourselves and address to make sure that you are compliant and up to speed on the ever-changing transfer pricing landscape.
Hi, everyone. I want to speak just, high level as to what transfer pricing is, and to kind of continue the topic of conversation that Chaya and Calvin had started as to the impact of the digital economy, and in particular on transfer pricing. So I'm going to start just, like I said, high level, talking about, what is transfer pricing. And it still amazes me to this day, actually, how many times I have to answer this question, considering how much it's been in the news recently. But basically, from a high level, transfer pricing exists when any kind of cross-border payment occurs between 2 or more related parties. Now, what do I mean by related parties? There has to be some sense of control, right? So from a legal standpoint, that means when, when a parent owns, 51% or more of a subsidiary, but it also is from the perspective of economic control. So we've certainly worked with a lot of clients and on a lot of transfer pricing work where it's not, that 51% isn't necessarily there, but they have the influence and control of being able to make decisions on behalf of the other entity. And then in terms of related parties, I alluded to it a little bit with the parent-sub relationship, but it also could be brother-sister companies, joint ventures, as well as portfolio companies. We're seeing more and more of that. So the purpose of transfer pricing, the purpose of transfer pricing and why it came about was because tax authorities essentially expected related party companies to operate as complete strangers. The concept and the driving philosophy behind this is what's referred to as the arm's length standard, and what that essentially means is market rate. And what we mean by market rate is exactly what I reiterated in that second bullet, is that all the local tax authorities expect companies to operate as total strangers, not as one big happy family. As a result, there's certain level of profit expected to be earned in each affiliate depending on their contribution and the value added to the global company. And that's where transfer pricing comes in. It is uses a variety of methods and analyses to be able to quantify that contribution and that value contribution to each respective entity of the global business. Now, a lot of people, will ask, well, how do companies use transfer pricing correctly, and how do they use it incorrectly, right? So transfer pricing came about and was a concern from the global tax authorities, mainly because they felt companies were using it to artificially shift income to low tax jurisdictions. So how would you go about that, right? So a classic example is that manufacturing distribution relationship. You have a distributor in Ireland and a manufacturer in the U.S. There would be an incentive to sell that product from the manufacturer to the distributor in Ireland at a lower price to increase the revenue in Ireland, whereas that same manufacturer might sell that same product to another affiliated entity in a country with a higher tax rate than Ireland at a higher price to therefore increase the COGS, decrease gross profit, and ultimately decrease the taxable income in that jurisdiction. So transfer pricing is a method, is a way of being able to support the pricing that currently exists, that's not happening. You're not artificially altering your prices to each of your different related parties, and that it's supported by not only what's referred to as a transfer pricing documentation study, but also analyses contained in that documentation study supporting your transfer pricing. So like I alluded to in the beginning, transfer pricing has been, just the topic of conversation, I would say the last 10, 15 years especially. Although it's been around forever, it's certainly become a hotter topic recently. And now with all the new regulations coming out, Chaya and Calvin spoke to a lot of them, the BEPS initiative, country by country reporting, it's putting a burden on more of our clients to get their transfer pricing right, to make sure it's correct, but also to have a tax efficient transfer pricing structure in place that works from an operational perspective of their business. And with more and more of these regulations coming about, it's putting more and more burden on the taxpayer to have it right and to have the support for their current intercompany arrangements. So this slide here is just explanation of kind of our approach on how do we go about looking at transfer pricing and valuing each individual entity as part of a global operation. Basically, what we look at is the functions, assets, and risks of the company, of each individual entity of the overall global business. The more functions they perform, the more assets they own, the more risks they incur, would naturally delegate a higher return for that particular entity. And we look at it in two ways: routine returns and non-routine returns. When we say routine returns, we don't mean low value added services or functions or simpler functions. We just mean routine functions that are easily quantified, so we then could calculate the contribution or the profit that that entity should be earning based off of the functions that they're performing and the risks they're incurring overall. Those non-routine returns, 9 times out of 10, always refer to the IP owner, the developer, the entrepreneurial risk taker of the global business. So because there are always two sides to a transaction, we always, in testing and performing our analyses, look at the routine service provider or the routine entity, the non-IP owning entity, because that is just naturally easier to identify and quantify from a value and return perspective. These next few slides, I just wanted to go through pretty quickly in terms of the impact the digital economy has had on transfer pricing. I think from what Chaya and Calvin were saying, the traditional outlook of how this, how transfer pricing has been viewed is changing. That arm's length perspective, a lot of the conversation in the transfer pricing community is, has the digital economy changed what the definition of arm's length means, of what we traditionally have looked at it as? And the answer is no, but also yes, right? There's of course still a need for transfer pricing and the arm's length philosophy, but the increase in technology, the digital economy certainly has changed how we look at it and has made it more difficult to assess that value contribution relative to the entire global operations. Like we said earlier, the economic substance isn't, necessarily what it used to be, right? It used to mean people, boots on the ground. That isn't the case anymore. Historically, people would actually need to be present. The digitalization of the economy has changed all that. A lot of questions that our clients are asking themselves and we're asking our clients are, what if a company now needs only AI in the location to support operations, but no people? How do we consider and value cloud-based software? Where are sales reflected for e-commerce businesses? These are a lot of the popular questions popping up. Data, artificial intelligence, machine learning, access to large amounts of consumer data has allowed retail businesses to understand and forecast consumer behavior, for example. AI is being used to diagnose emerging issues not necessarily spotted through existing quality control management systems. So all these further advancements in big data, AI, the process to gather and analyze the data is increasing value to a portion of the global business that may have been overlooked in the past, and therefore has become that much more important from a transfer pricing perspective to be able to identify and determine the value that that is coming out of those services and that all those different functions. Next slide, please. Again, just kind of a continuation, things to think about as from a transfer pricing perspective, as we're as going forward, and the different regulations related to the digital economy are coming out. Of course, IP intangibles are huge. It was important before all of these changes, and it's just as important, if not more important, going forward. Who owns those intangibles will always be a key question, regardless, because of course every tax authority wants to claim that their country owns the intangibles. In what ways has going digital changed the value chain, the supply chain for your company? Does it make sense to look at existing intercompany arrangements, agreements, and kind of take a second look and reevaluate them? And are the transfer pricing positions of your company still defensible? And if so, are they properly documented and supported? And this is what I was referencing to earlier with respect to the documentation study. All of these changes from a transfer pricing perspective, it's critical that you take another look at how your current transfer pricing has been in place, because a lot of the time our clients has been 10, 15, maybe more years, and they've had the same transfer pricing policy in place. And now is the time to start looking at that and start reevaluating. Is it still appropriate based off of where we are with the digital economy? Next slide, please. These are just two examples I thought were good ones just to show from a transfer pricing perspective, the remote working and the digital retail stores. Of course, due to advancement in IT, many businesses have shifted to working from home models even before COVID-19, but certainly that has accelerated it. Things to consider and monitor, especially with respect to key employees that may no longer be working in the country in which the entity is incorporated. Addressing that and acknowledging that is critical to manage any kind of transfer pricing issues, especially post-pandemic ones. And then from a digital retail perspective, we have a lot of e-retailers, a lot of retail companies establishing a digital presence that can take the form of a homepage, app, storefront on digital platforms. Retail businesses use these digital storefronts to serve customers beyond the methods traditionally employed within stores. For example, orders for goods collated through digital storefronts in multiple countries can be dispatched from a centralized warehouse, with customer relationships now managed from remote locations via social media. We have so many clients now where their customer relationships, their marketing is solely driven out from social media. And it makes it difficult, and it's a new challenge as to something we haven't had to deal with before, as to how to quantify the value derived from that relationship and the marketing intangibles associated with that. Another example, kind of related to the prior slide where I said having no people but automated processes. We're seeing a lot of this in the manufacturing space, especially where you have automation, AI doing all of these functions, and the people from either another country or outside that space where the process is actually occurring is providing more oversight in general. So I think these are just things to consider from a transfer pricing perspective. We certainly are. We're reevaluating again a lot of how we're quantifying and determining the value of each of the entities relative to the global operations, and the digital economy certainly has had a great impact on the transfer pricing world here.
Great. Thank you so much, Andrew. The IAASB, or International Auditing and Assurance Standards Board, is an independent body that sets international standards for auditing, quality control, and other assurance and related services. The IASB, or International Accounting Standards Board, is an independent group setting international financial reporting standards. Shannon and Christina are going to briefly touch on accounting standards, IFRS, that became effective earlier this year, those coming to effect in January, and an exposure draft for a new set of auditing standards. They will cover amendments to IFRS 16, rent concessions directly related to COVID-19, amendments to International Accounting Standards, IAS 16, property, plant, and equipment, specifically what proceeds and costs will now be excludable from the basis, interbank offer rate or IBOR reform, and a proposed set of auditing standards for less complex entities.
Thank you, Kimberlee. Shannon and I are going to provide a brief update on international financial reporting standards, new guidance, and some proposed auditing standards as well. So let's get started with the next slide. Under IFRS 16, rent concessions would be treated as modifications and either accounted for as a separate lease or a remeasurement of the lease liability using a revised discount rate and adjusting the right of use asset as well. Therefore, in May 2020, the IASB issued guidance to address rent concessions as a direct result of the COVID-19 pandemic. An optional practical expedient was included, allowing a lessee not to assess whether or not the rent concession met the definition of a modification and accounting for it instead as part of the original contract. In addition to the concession being a direct consequence of the pandemic, the following conditions must be met in order to apply the practical expedient. The change in lease payments results in revised consideration for the lease that is substantially the same as or less than the consideration for the lease immediately preceding the change. Any reduction in lease payments affects only payments originally due before June 30, 2021, and there's no substantive change to other terms and conditions of the lease. The practical expedient was extended for 12 months through June 30, 2022. If the practical expedient was previously elected under the original 2020 amendment, it is now mandatory to continue to apply it to other concessions with similar characteristics and circumstances. And that was effective for annual reporting periods beginning on or after April 1st, 2021. Currently, under IAS 16, the cost of an item includes the purchase price, any costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended, and the initial estimate of costs of dismantling, removing, and restoring the site on which it is located. This new amendment that will be effective January 1st, 2022, prohibits deducting the proceeds from selling items that were produced while the asset was being brought into use, such as samples, and capitalizing any costs of testing the asset to determine if it is functioning properly. These proceeds from selling items and costs must now be recognized in the statement of profit and loss rather than included in the cost of the PP&E. Next slide, please. Effective for reporting periods beginning on or after January 1st, 2020, IFRS 3 for business combinations was amended to add the definition of a business and to provide more clarity over application of the acquisition method for identifiable assets acquired and liabilities assumed, by stating that they must meet the definition of assets and liabilities in the framework for the preparation and presentation of financial statements at the acquisition date. The guidance was further amended, effective January 1st, 2022, to state that assets acquired and liabilities assumed must meet the definition of assets and liabilities in the conceptual framework. The conceptual framework defines an asset as a present economic resource controlled by the entity as a result of past events, and a liability as a present obligation of the entity to transfer an economic resource as a result of past events. And I'm going to turn it over to Shannon to discuss IBOR reform and a proposed auditing standard for less complex entities.
Thank you. So phase 2 amendments to IBOR reform are effective for periods beginning on or after January 1st, 2021. The amendments address issues as a result of the IBOR reform and amends IFRS 9, IAS 39, IFRS 7, IFRS 4, and IFRS 16. The phase 2 amendments only apply to changes required by the interest rate benchmark reform to financial instruments and hedging relationships. A company applies these amendments retrospectively, except when it will reinstate a discontinued hedging relationship, and companies are not required to restate prior periods. Next slide, please. In regards to IFRS 9, IBOR reform will likely result in a change in the basis for determining the contractual cash flows of the financial asset or liability. As a practical expedient, companies would update the effective interest rate of the financial asset or liability if it is a direct result of the IBOR reform and the new basis for determining the contractual cash flow is equivalent to the previous basis before the change. If there are other changes to the basis for determining the contractual cash flow, then a company first applies the practical expedient to the changes required by the IBOR reform and then the applicable requirements of IFRS 9. And an insurer applying IAS 39 would also follow this process. IFRS 16, when remeasuring the lease liability, it will use a revised discount rate that would reflect the change in the interest rate. To ensure the readers of the financial statements understand the effects of the IBOR reform, there are additional disclosures needed, which include how the company managed the transition to the new benchmark rates, including any risks that arose as a result of the transition and the status of the transition at the reporting date. Quantitative information about financial instruments, such as those with rates yet to transition due to the benchmark reform, disaggregated by significant interest rate benchmark, and showing non-derivative and derivative financial assets and liabilities separately, and the extent to which changes to a company's risk management strategy have occurred. And next slide. So in July 2021, the IASB issued an exposure draft for proposed international standards on auditing for audits of financial statements of less complex entities. These standards do not focus on the size of the entity, but the complexity. They are developing a separate standard which cannot be applied to listed entities, public entities, group audits, or when a jurisdiction prohibits the use of this separate standard.
Great. Thank you, Shannon and Christina, for that update on IFRS and all of the accounting standards. We're going to close out now. I'm going to talk to you a bit about how we work with HLB International, our international affiliate, and how we can help you grow around the world. So first of all, HLB is everywhere that you are and everywhere that you want to go. Through the power of HLB, we have 32,839 professionals in 159 countries around the world. All of these firms are very much like our own firm. They're local, but they have some international expertise. They have deep roots in their community, and they're closely connected around the world to their clients and to the world. So we work through them with a commitment to help you grow and provide solutions as you move forward. What's nice about HLB is that Withum is very involved, and every time we're referring you out to work and grow around the world, we're referring you to friends, people we have worked with before, people we meet with regularly, nowadays on Zoom meetings, but we're really growing to be one of the fastest and best networks in the world. At HLB, we, like our own Withum firm, HLB member firms take the time to get to know you, to understand your business and your needs, and then you'll have an HLB advisor at home in that local jurisdiction, and always communicating back to us. They'll grow your local business. They'll help you navigate through the business environment and introduce you to other advisors you might need. They'll keep us, your HLB home advisor, in the loop so we avoid misunderstandings and so that we're all on the page. You don't have on the same page. You don't need to be providing information to multiple advisors around the world. We'll all work together with that. So what does HLB offer? They have a broad range of services. They offer advisory, financial advisory, management consulting, cybersecurity, technology advisory, legal services, and risk advisory. Obviously, we offer all of the international auditing and accounting standards. They can help with IFRS. They can help with VAT. They can help with payroll, IT audits and financial statement audits. And new areas include sustainability. Now, this is coming out. It's very big in Europe right now. So anybody that needs to be audited has to have a sustainability report, and we can do that. We also, my favorite area, we also offer tax advice. VAT. We can offer withholding taxes, corporate income taxes, expatriate taxes, and transfer pricing. So anything that we can do here at Withum is offered by our affiliates around the world, and also they offer more services specific to the country that you're in. They also operate in almost every industry. We have specialty groups in agriculture, in automotive, in healthcare, emerging technologies. A lot of these specialty groups are run by some of my Withum compatriots. We have real estate and construction, technology, just almost any industry that our clients work in are also offered as expertise areas in HLB International. We're pleased to announce that HLB was awarded the Network of the Year in 2000. We have been a very fast-growing network. We have just been growing and gaining expertise and also really raising the level of services. So every HLB member firm goes through a peer review, and so they're providing the same quality of services that you've come to expect from Withum. You can expect those from people, from our colleagues at HLB around the world. We also are really growing in China. We have a global China service initiative. So it's one of the world's leading economies, and it's going through some issues, but we have HLB members on the ground in China working together. We have people even from Europe and Africa who specialize in the Chinese economy, the Chinese language, Chinese accounting. So no matter where you're going in the world, you can get into China and get out of China, and we can help you work through the China service desks to get there. So I want to briefly introduce you to the team at HLB International. Our chairman is Corné Versteden. He is based in the Netherlands. The main offices of HLB International are in London, and they're headed by Marco Denzelli, our CEO, and Abu Bakr is our CIO, our Chief Information Officer. Coco Liku, she's the Chief Relationship Officer for our Global China Services, and Lisa Benson runs our Western markets, so Europe and the Americas. Anant Patel, who is our colleague at HLB Hatson Green & Jenks in Los Angeles, he runs our transaction advisory services. Our own Dave Springsteen is the global tax leader. Bettina Casgrain is the technical director of HLB, and she runs our global assurance. Again, our own Jim Burke is the head of technology advisory. And I sit on the International Tax Committee and assist with clients going around the world. Some of the recent transactions that we've worked on is we've helped companies looking to expand into Europe, and they're expanding all over Europe. And so we've helped them determine which country they should go into first, how they should set up. Will we have the capabilities to do their accounting, to do their auditing, to do their payroll, to do their VAT compliance? And all of that can be done through one relationship with us here at Withum, and then we reach out and work through our HLB affiliates abroad to get you all of those services that you need. And you can basically have one-stop shopping coming into Withum and then getting into HLB and then expanding around the world. With that, I'd like to bring back my whole international team here. Thank you for joining us today to discuss the wide world of business. I'd especially like to thank Chaya and Calvin, who covered international tax update, Andrew DeSimone, who covered transfer pricing, Christina, Flynn, and Shannon Metz, who covered the international accounting standard changes, and mostly you. Thank you for joining us, and we hope to hear from you in the near future.